Now, I'm not exaggerating here. In this interview, you get to hear from an individual that was CEO of a company that sold for over $60 billion. His name is David Garofalo. It's amazing. He was the CEO of Gold Corp, which ended up selling to Newmont as the largest merger in the history of the precious metals industry. He's been involved in Agnico Eagle, which when he came on board to when he left, they had a 100-fold increase in market capitalization. So talk about a guy that knows how to become very, very, very successful. And so he's now involved in a company called Gold Mining Inc., and he's going to be the CEO of another company called Gold Royalty Corp. So he's going to talk about those investments as well. This is an amazing opportunity to hear from one of the most successful people to ever do it in the gold and silver industry. He's going to be talking about investing trends and the overall opportunities that are out there in the world right now with your money. So make sure you hit the like button on this side right over there or this side right over there to send this out to the YouTube universe so more people see the video. Leave a comment down below if you enjoy this interview or one thing you learned for it, or if you want to have David back on the channel. Thanks for watching.
Thanks for having me on, Jake. I'm delighted to be here.
Yeah, it's incredible. So let's start with the true-false question, David. So true-false, the gold stock industry and silver stock industry will become, if not the one of the largest investment trends of 2021 and the next few years.
Yeah, look, I think there's absolute truth to that because it's part of a broader macroeconomic trend, which is quantitative easing, which is a euphemism for printing money, right? And it's happening in a coordinated fashion across the industrialized world, across all the central banks. They're really co-conspirators in undermining fiat currency by printing more of it. And the reality is paper currency is infinite in quantity. If you have a printing press, you can make it. And the reality is with gold, it's very, very finite in quantity. If you look at all the gold that's been produced since the beginning of time, it's about 200,000 metric tons. Visually, what that is about 4 Olympic-sized swimming pools full of gold. It's
wow, that's it.
Tiny. Wow. It's a very small quantity. And so you can imagine as this wall of paper currency comes into the market, and we're seeing rapid inflation in general equity prices, but you're going to see, and you have seen, inflation in gold equities as well, and also in the gold price. And gold is a barometer of what's happening with paper currency. And you know, another metric that really describes and illustrates the amount of paper currencies being introduced is the level of interest rates, which on a nominal real basis is now negative. In other words, there's really no opportunity cost owning gold anymore. I mean, it used to be called a barbarous relic. Warren Buffett wouldn't touch it until recently. And the reason he's looking at it now is on a relative basis, there is no opportunity cost. The interest rates on gold, which are zero, is actually better than what you would get on a sovereign debt instrument that you'd buy out in the market, whether it's the US treasuries or Canadian treasuries or Euro treasuries. You're not getting the yield. And you're dealing with the prospect of currency being undermined, by central banks printing more of it. So why not preserve capital while you're getting zero yield, but it's still better than negative yield? You're getting zero yield on gold, but gold is finite in quantity. We're only producing about 4,000 metric tons per annum as an industry. So really not adding appreciably to the supply, not nearly to the extent they're adding to fiat currencies.
I definitely later want to ask you about fiat and I want to ask you about peak gold, and we'll get into a lot of great stuff. But I think maybe the reason Warren didn't get into gold sooner is he didn't know that you were out there positioning Gold Corp to sell it for $62 billion, or he might have got in there sooner. But let me ask you, when you look at everything going on, we had Bank of America call for $3,000 gold, which that really surprised me. I mean, it seemed like that was kind of out of the blue. And then we had Warren Buffett say he's getting in, and I've heard from many other people that I've interviewed say they've started to see a lot more institutions getting involved. So how you've seen this huge uptick in momentum into the gold stocks specifically and silver stocks specifically. What do you think has caused that? And has that what has occurred recently changed your overall investment thesis on gold and the potential that it has?
Well, let me address first Merrill Lynch's forecast of $3,000 gold within the next 18 months. And that's not nearly as outrageous as it might sound, because if you look at gold prices back in the early 1980s, I think 1981 it achieved a peak at the time of about $850 an ounce. Don't forget, that's $1981. If you inflate that to $2020, it's close to $3,000 an ounce. So Merrill Lynch didn't pull that out of their hat. Okay. It came by looking at past cycles and how gold has behaved in inflationary times. And ultimately, gold is a barometer of impending inflation. And we're obviously going to experience that. And we are experiencing that in general equity prices. I alluded to that a little early on, but the valuations, the multiples that we're seeing in general equity markets are completely unprecedented, because there's a wall of paper that's chasing these stocks right now and stretching the valuations to beyond the recognition of any historic multiples. And so it shouldn't be a surprise that Warren Buffett's now looking at gold equities and saying, well, I'm a value investor. General equity markets are not value right now. Where in the general equity markets can I find value? And gold companies are actually a value proposition, because they're still discounting probably $1,400 to $1,500 an ounce in their underlying valuations. And gold is at 2,000, going to 3,000 and beyond. And so the market's going to have to start to catch up and start to pay gold equities the kind of valuations they deserve as real businesses. And gold companies are far better off than they were 10 years ago, when gold achieved $1,900 an ounce, the previous peak. Now, more recently, we're at $2,000 an ounce. Back then, gold companies were experiencing rapid input cost inflation. And that's because we were in the middle of the Chinese super cycle, and materials prices generally were going up, not just gold, but also base metals. We're not experiencing that now. So there isn't that competition for scarce resources or inputs that we had 10 years ago, with the base metal companies and gold companies both trying to build new capacity. That's just not happening. And so what we've seen is significant stabilization in the input costs in the industry. Oil prices are down. A third of our costs in the industry is energy related. We're a very energy intensive business. So we've seen our costs go down on the energy side. We've seen local currencies weaken against the US dollar, which means our local costs have gone down in US dollar terms. So if you're operating in Canada, you're operating in Australia, you're operating in South Africa, or in Latin America, those currencies have all weakened against the US dollar over the last couple of years. And so our input costs locally have gone down. So you've seen much stabler costs, and these businesses are vastly more profitable than they were 10 years ago at similar gold price levels. So we're providing that leverage proposition in the industry that we didn't provide 10 years ago, when we saw cost inflation across the entire mining sector, not just in gold.
That's super interesting, right? So you're saying, and because of that, then a smart investor like Warren Buffett, he doesn't care. Is it gold? Is it Pepsi? I don't care. Just look at the financials and they're incredible. And that's what's happening, you're saying?
Yeah, and he's a microcosm for the generalist investor. He happens to be a thought leader, obviously, but the general investors are saying, well, I'm looking at this as a business. How does this business compare to widgets or cars, or, widgets is kind of a placeholder for any other industry. They have to look at a broad array of industries, and they're going to look for things that provide value and the prospect for outperformance. And clearly, with gold being or gold equities discounting somewhere between $1,400 and $1,500 an ounce, that's deep value relative to where the gold price is today. And with the prospects of gold going up for the foreseeable future, as long as there's quantitative easing, which Jerome Powell has told us he's not even thinking about raising interest rates, that tells you we're on a path for continued debasement of paper currencies, which will only drive gold prices up higher.
Interesting. I always say, I'm like, what business can you have your product constantly increasing in price while your actual cost to produce it keeps going down in price, and there's less and less of it available? It's like, who cares what it is? Get me in on that. So that's very fascinating. So,
and you referenced that before, Jake. You talked about peak gold, and that has happened. We've had peak gold actually about 8 years ago. If you look at reserves, gold reserves in the ground, within the portfolios of established producers, that's down 50% over the last 8 years. Because while we were focused on improving profitability as an industry, we were keeping our costs stable and not redeploying or reinvesting capital back into the ground in exploration to replace depleting reserves. And the juniors have been starved out of the market until recently, until really the last 6 months. Juniors couldn't raise a dime to save their lives. And so they weren't doing the grassroots exploration that the industry needed to replace its reserves. So reserves could only go in one direction. And that's a leading indicator of what's going to happen to production. There's always a delayed reaction. There's a delayed reaction on the way down. As reserves go down, production eventually goes down. And look, even if there was a significant new discovery tomorrow by one of the juniors or one of the established mining companies, the lead time from discovery to first ounce of production in any mine is a minimum of 15 years.
Oh, wow. That's really
so. Even if there's a big discovery tomorrow, we're not going to see the impact of that on production for 10 to 15 years at a minimum. And so we're on a downward trajectory in production for the foreseeable future, which only amplifies the fundamentals, the positive fundamentals for gold. There is going to be a supply deficit as this wall of new currency comes back into the sector. The generalist investors and the like start to put serious capital to work in the sector.
So first, I was going to ask you something else, but let me ask you this, since you said that. You said when generalist investors start to put serious money in, when do you think that's happening? Or do you think it's slow and it'll just keep picking up until a FOMO starts? What's as someone who's experienced as you, what's your take on the sentiment right now?
Yeah, so I think it's positive. I think the generalists are having to do their work on it. Don't forget, 40% of the equity markets now is index investing, the passive investors. So you're starting to see more and more weighting in the gold sector on the major exchanges, and that'll just feed on itself, and eventually the generalists would, the discretionary money, they hug the index at the end of the day because they're all worried about whether they're going to keep their jobs or not the next quarter. Right. And so they'll hug the index. And so it'll just feed on itself. Yeah. The momentum will be violent when it happens. It isn't a gradual, it isn't a steady line upwards. You're going to have periods where there's violent volatility upwards, and then there's going to be a correction. Nothing goes up in a straight line, but you can see that we're building on, higher lows every day. And that will only over time feed on itself and see, as I said, a wall of capital come into the sector in a very, very major way.
So nobody knows exactly what's going to happen, but you're about as experienced as it gets. Do you think that all of the things you just illustrated about why this is so attractive, if you get out the idea of even what the product is, whether it's gold or Pepsi, and you look purely at the industry, the financials, all these things, and you look at the overall sentiment, but then you look at the larger macro picture of how much money we're printing, how much more is going to have to be printed, is anyone's guess. Does this right now look to you like the most attractive time to have a huge wealth transfer, really, in the gold industry? Is this the most attractive time to invest in gold stocks and silver stocks, in your opinion, based off of your experience?
Yeah, absolutely. I never, this is unprecedented times, and unprecedented in the fact that we've seen a global coordination of money supply increase. Yeah. We started to see that in the credit crisis 10 years ago, and that kind of set the precedent. But now we're at an entirely different level, and COVID accelerated that. Yeah. The whole pandemic crisis accelerated the coordination of increasing money supply. We were already experiencing fairly anemic growth globally before the COVID crisis, and we were already starting to talk about walking interest rates down, increasing money supply. That's only accelerated that momentum. And it's this global coordination that we didn't experience back in past gold cycles. Central banks didn't talk to each other to the extent they do now and coordinate their efforts. And now they're all competing to debase their currencies to preserve their export markets. So that's a fairly recent phenomenon. So that trend towards globalization that we saw in economies over the last 15 to 20 years, which we didn't experience 30 years ago, the integration of our economies globally has also driven our efforts in terms of introducing more fiat currency into the system, both in terms of the credit system, the equity markets, and whatnot. And central banks have gone from controlling inflation to looking at, well, where's the equity markets going? Where are employment levels? That's really not what the mandate of central banks was historically. They were supposed to control inflation within a strict band. Now they're looking at employment levels, and they're kind of nodding and winking, saying, well, we're concerned about where the equity markets are going as well. And Greenspan kind of went that direction. He talked about irrational exuberance in equity markets. That was unprecedented at the time. He shouldn't have been looking at the equity markets. He shouldn't care. He should be concerned about whether our inflation targets are being met right now. That's completely out the window now.
And that's interesting. And that shift in mindset by the Fed actually makes gold stocks more attractive, because if they're no longer looking at interest rates, then if you're looking at jobs, then interest rates don't matter. Jobs just matter. And actually you need to keep going zero or negative and more money in circulation to satisfy the job quota, which, as you said, that's a really interesting point. I never thought of it like that.
And the other element of that is the fact that we've strapped on incredible amounts of debt, not only at the government level, but even in industry, at the consumer level. The central banks can't afford to raise interest rates. It would just undermine the economy, undermine confidence. And so now we're seeing central banks buy sovereign debt and buy corporate debt as well, in order to keep the credit markets moving. We've never seen that before. The balance sheets have just been increased significantly beyond recognition, beyond any precedent we've experienced in the past. And so they're just printing money and just buying the debt. They're inflating their way out of debt because they know we're never going to be in a position to repay it.
Yeah, it's incredible. I mean, it's so exciting. It's very scary I have a 2-month-old daughter. That concerns me. But as an investor thinking, how quickly can I become financially independent? My guess is by my early 30s, I could throw away my computer if we keep at this pace. So speaking of that, like 100-fold shift, then let me ask you, so I want to make sure I hit this right. So you were brought on with Agnico Eagle, which everyone knows it's one of the most premier companies for miners in the world. So they had $100 million market cap when you joined the leadership team. And when you left to become CEO of Hudbay, Agnico was a $10 billion company. So 100-fold increase in size when you were involved. And today they have a market cap of 20 billion. So what is your secret sauce on making these gold companies so successful?
Well, what it was fundamentally doing the basics right, and drilling and building. And Agnico Eagle had a long history of mine construction operations going back to the 1950s. And we built 6 mines at once in the 12 years that I was there. We started with a very small management team, myself, Sean Boyd, who's still the CEO to this day, Ebe Shirkus, who retired as CEO. It was just the 3 of us at the time. And we built out that company one asset at a time. And we acquired development stage assets, drilled them out, grew them geologically, and built them out to productive mines. And we also experienced a big uplift in the gold price from $250 an ounce in 1998. By the time I left, it was in the high hundreds, which doesn't seem like a high price now. But back then, we thought we were in heaven, approaching $700, $800, $900 an ounce. And our timing was just perfect as we brought on all this new production just as the gold price was starting to experience a big uplift. So doing things fundamentally well is extremely important. You have to drill and build your way to success. And I think ultimately that's what led to the significant increase in the market capitalization of the company. Today, Agnico's double that. They've continued to drill and build their way to success. Gold prices have more than doubled from when I left in 2010 to go run Hudbay, which is a base metal or copper company. And that fundamentally led to the big increase in creation of value in the sector, and so that's really, really important. But what's happened is the art of mine building has been kind of lost on the sector over the last 7 or 8 years, because Investors were rightfully demanding the companies focused on profitability after that big input cost inflation we experienced 10 years ago. And so what they've sacrificed is exploration and mine development. And that's why we've seen reserves come down. And so at this stage in my career, what I'm foreseeing is a big wave of capital coming from the producers into exploration and development stage companies. And that's where I think you're going to get maximum leverage to the gold price right now, because as I said, mining companies are fundamentally just a collection of finite life assets. Every day they produce an ounce of gold, they're dying a little bit. And they've been dying now, given the reserve profile that we've experienced as an industry over the last 10 years for close to a decade. They're going to have to turn their sights back onto replacing their depleting reserve base and depleting production profiles. And so I do see a capital coming from the producers into the development stage companies, and the equity markets will have to follow because there's going to be a lot of M&A. If they're not finding it in the ground, they're going to have to buy it. And so they're going to have to buy these development stage assets. So I position myself with gold mining, which has a collection of 14 development stage assets that Amir Adnani had bought at the bottom of the market. He paid $2 or $3 an ounce on average for 25 million ounces of resource across 14 properties. And when he bought them, they were out of the money. $1,100, $1,200 ounce gold, they wouldn't have made money. Today at $1,900 to $2,000 an ounce gold, they're highly economic. And so what we're trying to do is daylight value in these assets. One, by pivoting the company from inventorying these assets and inventorying ounces to actually developing them and incubating them. And so we've hired a development executive into gold mining who used to work with me at Gold Corp, Alistair Stell. He's a mine builder, mine operator, and he also ran the corporate development function for a Canadian business at Gold Corp. So he brings a wealth of experience, about 30 years in his own right, towards de-risking these assets. And the other thing that we did is we wrote royalties on each of these 14 development stage assets and created a new gold royalty vehicle called Gold Royalty Corp, which I've been brought in to run. So I'm on the advisory board of gold mining, and I'm helping them to pivot from inventorying assets to actually incubating them. And at the same time, I'm taking a royalty on those projects and creating a new standalone vehicle, which we intend to take public over the next few months. And royalty companies are extremely important to developing new gold assets because they effectively act as a bank. They raise money in the markets, and then they invest it into development stage assets and take a royalty back. And so they really act as a bank for developing new mines because they can access capital much more cheaply than gold mining companies can.
That's fascinating. So you go from doing this 60 billion something merger, the biggest merger in history, and then your next thought is, well, given these problems with lack of development and then these problems with peak gold, your thoughts were, let me get involved in a project that has 25 million ounces in the ground. And is that what originally brought you to gold mining? And then you guys realized you had this very innovative approach where you could combine a royalty and streaming to it? Is that basically what happened?
Yeah, it is. And what I recognize in that portfolio that Amir had assembled is these are the types of assets that the mining companies, the producers need because they have not been discovering new deposits. But we have an inventory of 14 projects across which we have 25 million ounces collectively. We have big ones, we have medium-sized, small ones. They appeal to a broad array of producers, big, medium, and small. And so by pivoting towards incubating, we're inviting these gold producers to come in and joint venture, earn into these projects to introduce some optionality into their pipeline. And by doing that, we're going to be daylighting value for gold mining shareholders. The other way we're daylighting value is, as I said, writing royalties on each of these projects and creating a separate public gold royalty vehicle and spinning it out into its own public company. And effectively, if you're buying a gold mining share, and we're listed on Toronto Stock Exchange under the symbol gold, on the over-the-counter market in the US and the GLDLF symbol, if you're buying gold mining, you're getting the gold royalty vehicle for free. Because we haven't taken it public yet. But when we do, we're going to daylight a lot of value, and we intend to take it public over the next few months, daylight a lot of value that will accrue to the shareholders of gold mining.
Really? That's fascinating. Has anyone ever, this sounds incredibly innovating. It's very genius to combine it together, huh?
I'd love to say it's innovative, but it's not. And I'll tell you why. Because I've invited Ian Telfer onto our advisory board. He's the chairman of the advisory board at Gold Royalty Corp. Ian Telfer was the father of the gold streaming model. He
Huh.
created Wheaton Precious Metal 15 years ago, and that was spun out from Gold Corp,
Oh,
the
it was?
company I used to.
Interesting. I didn't know that.
Yeah, so what he did is he took a royalty portfolio on some of his existing mines and he put it into the separate vehicle. And you know that Wheaton Precious Metals now is bigger than Gold Corp ever was.
Wheaton
So
was up 80% in June or July. I did fantastic early with my mom and my mother-in-law, and it's exciting.
Randy Smallwood, who runs Wheaton Precious Metal, used to be a Gold Corp employee. That's where he started his
Wow,
career.
that's interesting.
So he was spun out with that vehicle. And as it turned out, the son has grown bigger than the father. And so I've been able to invite Ian in to the Gold Royalty, and I've taken basically the guy who pioneered the whole streaming model. He's coming to help us build out this new vehicle, Gold Royalty Corp. So he's done it before. We're going to be leveraging his network, his expertise, and taking his model and making it better. And we're starting with a big mineral endowment, 25 million ounces underlying that royalty portfolio within gold mining. So it's a very similar model to Gold Corp and Wheaton Precious Metal. And for that matter, Franco, which is the biggest royalty streaming vehicle in the world by market cap, came out of Newmont, the biggest gold company in the world, which we merged Gold Corp with last year. You can see how small this universe of mining royalty companies is. But the most successful and enduring royalty companies are ones that have been spawned out of existing mining companies, where they took a collection of royalties on the existing producing mines and daylighted dramatic and significant value for shareholders by creating this royalty vehicle. And Jake, let me tell you why royalty companies typically trade at two to three times the multiple that the mine producers do. Because they have top line or just revenue exposure. In other words, royalty companies take a percentage of the revenue within the mines. They have top line exposure. What they don't have is any of the underlying risks associated with mining in terms of operating cost inflation, capital cost inflation. They just take top line exposure. So if the gold price goes up, the royalty goes up. They get leverage to the gold price. If these mining companies find more resources around those existing mines on which those royalties are written, then the royalty company participates in that exploration upside as well. So you get maximum leverage to the gold price and maximum leverage to exploration success without any of the underlying risk associated with cost inflation.
That's fantastic, especially since now everyone's starting to enter generalists, but maybe they are a little afraid of some of the stocks, so they get a safe haven with the royalties, but there's only so many of them, right? So that's fantastic to hear that, and that's super interesting. So all around, I gotta feel like you're very, very excited about the prospects between your involvement in gold mining and your involvement with the royalty company. What do you see on the horizon over a finish to this year, and how you see playing out in the markets and with your investment vehicles that you have with both your royalty company and your workings with Amir Adnani?
Look, I think once we get through the election cycle in the US, I think we'll be going back to having the markets focus on fundamentals. And fundamentally, gold is extremely well supported, both in terms of the increase in money supply, the continued diminishment of mine supply and reserves. That's fundamentally supporting gold very, very strongly. And I expect gold to get back on track once we get out of the election cycle and people can focus on the fundamentals again. And again, we're focused on the development end of the spectrum, because that's where the capital will have to come in fairly short order. It's become an existential imperative for the producers to actually put capital to work. And we're starting to see that tentatively now, but it'll happen. And when it happens, it's going to happen very quickly and violently. And we're positioned with gold mining and gold royalty to benefit from that inflow of capital into the development end of the cycle.
Fascinating. So let me ask you here, kind of in conclusion. So let's say somebody, because there's two different camps, right? Or we'll call it three. One is gold is a relic, I don't want it, which was my my mother and my mother's boyfriend, who's a wealth manager, who thought I was a nut job with all my gold and silver. And now he has over 15% of his portfolio in it because he's just looked at the finances, right?
Yeah.
So there's that camp that's starting to say, oh, wow, this is an interesting place that I might be able to put my money. And then there's the camp that says, if you don't hold it, you don't own it. They only want physical gold or physical silver. That's it. And then there's other people that are very interested in gold stocks, and they understand the wealth multiplying potential of it. And while gold might be the thing that preserves your purchasing power, the gold stocks could be the thing that really accelerate your net worth and your wealth during the cycle. So let me ask you, as someone who's as experienced as you, kind of in conclusion, right? Because you talked about the overall sentiment, you talked about the financials, you talked about big people like Warren getting involved, you talked about your own vehicles being involved with Gold Mining Inc. and your royalty company. So if people are interested in that, but why is gold stocks and royalty companies and the overall precious metal stock specifically, why is it so attractive? Why is it such a thing that investors should really be aware of? Can you elaborate more when somebody says gold stocks? That sounds not good. How is this so amazing?
Yeah, look, what we're talking about in gold equities, whether it's producing gold equities, development stage equities, or the royalty companies, is leverage to the gold price. You can very readily buy the physical. You can buy the bars, you can buy the coins, or you can put it in a safety deposit box, or you can buy the GLD on the New York Stock Exchange physically backed by gold. But what you're not getting is the leverage that that's provided by gold equities. And we can look at the whole spectrum. Gold equities provide meaningful leverage, probably less so than the development stage assets and the royalty companies, but they provide leverage because as the gold price goes up, their profitability goes up, their margins go up, and the percentage that their margins go up will exceed the percentage that the gold price goes up, assuming costs are stable. And so that's the leverage proposition. So if gold goes up 10%, their margins may go up 30 to 50%. There's the leverage in the gold equities. But their costs are not always stable. Sometimes they go up. And so that undermines that leverage proposition. So if you're looking for the next level of leverage, then you look at the gold royalty companies, which provide maximum leverage, both in terms of the gold price performance, but also exploration success. So if the underlying gold mining companies deliver on increased reserves around their existing producing mines, then the gold royalty companies participate in that fully without the operating costs and capital cost exposure. What development stage assets provide is meaningful growth. In other words, development stage companies find things in the ground that people didn't know existed before, to find new resources, new reserves, de-risk them, and deliver maximum value through M&A, through developing and de-risking these assets and bringing them up into productive mines. So there's a number of ways to play it, but I would say at this end of the cycle, given where reserves have gone, which is to say they've declined by 50% over the last decade, there is going to be more leverage in the earlier side, in the development stage assets. So looking for those good prospects, geological prospects that have the potential to be developed into producing mines is where we're going to see maximum leverage to the gold price at this end of the cycle, in my view.
And the reason is because, say, you're coming off a very unloved industry. None of these mines have been taken care of. Everyone's kind of looked at them as a relic for so long. And while the gold price has started to really pick up, obviously a lot past 2000 for a while, a lot of these developments that are so important that have real resources in the ground are still very undervalued. So you're saying that once the money comes up, those are the things that can have the biggest quantum moves because they were so devalued or undervalued for so long?
Absolutely, and I'll give you a very tangible and objective example of that. As I said, Amir bought the 25 million ounces in the 14 projects that we have within gold mining at $2 to $3 an ounce.
Jeez.
Today, that's trading at about $14 to $15 an ounce. But a de-risked project could trade in the hundreds of dollars an ounce. So you can see the potential leverage proposition as these projects get de-risked, which is why we're pivoting gold mining to de-risking these projects at this end of the cycle, because you recognize that the producers are going to have to buy assets like these, and they're going to drive up valuations to levels we haven't seen in a long, long time, and out of necessity, because they have to replace their depleting production profiles.
Wow. Yeah, that makes them so exciting, especially when you see how undervalued they are. So I know you're a busy man and you got to get going, but I wanted to ask you, we talked about your macro views. We talked a little bit about some of your past success, and then we talked about your current vehicles that investors can consider with gold mining and your royalty company. But let me ask you personally, and I look at your success and the amazing things that you accomplished, like what on earth for us listening that want to create more success and want to create more financial freedom, and we see these chaotic times and we're like, man, I got to really achieve my goals. I got to hit the next level. And then, we have the opportunity to listen to someone like you. What made you so successful, and what advice do you have to an entrepreneur, an investor, or a business owner right now that you think are important for people to know?
Well, look, I've just stuck very close to my knitting over 30 years. I've been in the industry for 30 years, and I continually leveraged the network that I have to be successful in all of the 4 companies that I've worked with over the 30-year period. I'm drilling and building, but also leveraging my network to get the next opportunity to introduce into our portfolio. And that's precisely what we're doing with Gold Royalty. I'm going back to my old network. John Griffith, who's my head of corporate development at Gold Royalty, has been a trusted banking advisor with me at Bank of America Merrill Lynch for 25 years. I was able to poach him and bring him in. Ian Telfer, again, the father of the streaming and royalty vehicle, brought him in, leveraging that network, that expertise in order to introduce new opportunities into the pipeline. Warren Gilman, who's joined our board at Gold Royalty Corp, a very successful investment banker back in the day, and now a very successful investor managing Li Ka-shing's money out of Hong Kong. And he's putting capital to work with this royalty vehicle as well, and has been a steadfast investor in the gold mining space for a very long period of time. And so it's leveraging that network. I alluded to this a little earlier on before we started recording, how small the network is and how small the universe we operate in is. We continually go back to these people and leverage their expertise and their networks to build out companies. And ultimately, that's the key to success is knowing who's competent, who has that network, and continually going back to it to deliver returns for our shareholders.
Okay, you and Rick Rule are both too modest. So I hear the network component, and it seems a common theme between the most successful people in this industry. They all they work together, next project. So I get that. Then you said you stuck with the same thing for a long time. Seems like that's everyone's pitfall. They keep starting and stopping everything, and you have this amazing compounding effect. But you were the CEO of a company that sold for 60-something billion. Like, what's the more success principles? Like, how do you do that? Like, what was so special about you as a CEO versus 100 other CEO companies? What's one more success principle that you have for us?
People. It is. I mean, I've spent the majority of my career developing people. There are more than a few people in the C-suite in the mining industry that I've mentored. And I was mentored by some really, really capable people in my career. And so it's continually developing a pipeline of people underneath you.
So you had mentors.
To replace you. People that can go toe-to-toe with you and replace you and challenge you and deliver value. So it's all about the people you surround yourself with. That's really what makes you successful at the end of the day. And I'm very, very proud of the fact that I can point to, a dozen different companies that have people in the C-suite that have worked with me and for me over my career.
Interesting. So final question, what is one thing right now you are excited about in your life or grateful about right now in your life?
Well, I'm grateful to be in this industry at this end of the cycle from a business perspective, but I'm also very grateful that I have, a great family. I have 8. I know you've got a young child. We have 8 kids between my wife and I, and they're all doing exceedingly well. 4 of them are out of the nest. Another 4, you can see the light at the end of the tunnel, and that's incredibly gratifying. It's more gratifying than anything I've ever done professionally is to see kids take flight and take responsibility for their own lives.
That's amazing. Fantastic. Well, they're going to be proud of their dad after this cycle. I'm sure it's going to be exciting. So thank you very much for joining.